Over the past 2 weeks, U.S. 5-year Treasury yields have moved from 2.7% up to a current level near 3%. Now, the move in 10-year has been almost identical, and they both hover near 3% now. Now, this happens to coincide with the Fed embarking on its quantitative tightening program. Now, essentially, quantitative tightening is the opposite of quantitative easing, except in this instance, instead of actually selling bond holdings, the Fed plans to let maturing bonds roll off their balance sheet. Now, quantitative tightening's primary impact is to remove liquidity from the financial system and allow longer end rates to rise. Now, the uptick in rates is also happening days before Friday's CPI read. A month ago, CPI, although still extremely high, gave some analysts reason to believe that inflation was in the process of peaking. If CPI surprised to the upside this time, it could galvanize the Fed's resolve in raising short-end rates manually and becoming more committed to QT. Now, if a trader believes that 5-year yields are poised to move higher, they could express that by buying the June micro 5-year Treasury yield futures contract at 3.01 and target the 2018 highs at 3.23. A stop for this trade could be placed below at 2.88. This trade could make $220 if your target is reached and risks $130 if you're stopped out of your level. Now, if a trader believes that 5-year yields could potentially move lower, perhaps on a belief that inflation has peaked and could be heading lower itself, they could express that by selling the June micro 5-year Treasury yield futures contract at 3.01 and target the late May lows of 2.70. A stop for this trade could be placed above at 3.21. This trade could make $310 if your target is reached and risks $200 if you're stopped out of your level.